You round up your coffee, 97 cents becomes $1, 3 cents dips into your investing app. Progress bar fills a hair. You feel disciplined like a real investor. Here's the part that nobody tells you. That feeling is the product, not the 3 cents. Somewhere in the last few years, an entire industry figured out how to sell you the emotion of investing while quietly keeping the actual investing to a minimum. By the end of this video, I'm going to show you the math, but that's not even the part that will bother you the most. Near the end, I'll hand you a 3-step blueprint on how to move your money out of these apps and into something that actually compounds without losing the habit that got you investing in the first place. Stick with me because most people watching this video have one of these apps installed right now. And by the time we're done, you're going to be looking at that little icon completely differently. Open any Roundup app right now and you're not really looking at a brokerage. You're looking at a slot machine wearing a cardigan. Buzz down when the Roundup hits like you just closed an achievement for a video game. Some apps now animate coins visibly flying from your card into a jar on screen. None of that is an accident. It's the same reward architecture behind mobile games. Same frequent, unpredictable wins that trigger a dopamine hit completely disproportionate to the actual money involved. By 2026, a lot of these apps have basically merged with social media design, streaks for investing every day, leaderboards showing what your friends rounded up this week, little badges for hitting a savings milestone. It's the exact same design language as a fitness app or a language learning app because the goal isn't your net worth. The goal is your daily open rate. These apps always give you a mini payoff. That's why roundups feel so good. You're not imagining it. Your brain is getting rewarded for spending money dressed up as investing. Here's the problem that creates. When investing 50 cents, it feels like a win. Your brain quietly closes the case. I'm handling this. The box feels check, and a check box is the enemy of a bigger box. That's the actual cost of the progress bar, not the 50 cents, the automated $500 transfer you never set up because 50 cents already gave you the feeling of being responsible with money. There's a name for this in psychology. It's called moral licensing. One small good behavior gives you permission to skip the bigger one. It's the same reason someone orders a diet soda with a burger and fries and genuinely feels like they made the healthy choice. The soda isn't the problem. The soda is what lets everything else off the hook. The app isn't lying to you. It's just letting you lie to yourself for free forever. So the roundup habit isn't harmless. It's a placeholder emotion parked exactly where a real, boring, automated contribution should be. And underneath that good feeling, the second you tap invest, math starts happening that has nothing to do with how good the app made you feel. Here's what actually happens to that 50 cents. Fractional and roundup trades don't always fill at the price you saw on screen. A lot of these platforms batch tiny orders and route them through market makers. And there's often a small gap between the quoted price and the price your fraction actually executes at. That gap is called the spread. Spreads aren't inherently evil, by the way. Market makers take risk to fill on your order instantly, and they get paid for that risk through the gap between the buy and sell price. That's normal. That's how liquid markets work. The problem isn't that a spread exists. The problem is how many times you're paying it. One big trade, that spread isn't as impactful. But you're not making one big trade, you're making one every single day, sometimes several for years. And a small percentage lost, repeated thousands of times, stops becoming a rounding error and starts becoming a leak. Let's run a number on it. Say each fractional trade eats a modest 0.5% in spread. Round up 45 times in a month, and that's not 0.5% ding, it's 40% of it, compounding against you before your money's even finished settling. Now picture two versions of you. Version 1 rounds up 40 times a month, 40 tiny trades, 40 tiny tolls. Version 2 takes the exact same total dollar amount and buys it once a month. Same money invested, wildly different number of toll booths. And this isn't just a roundup problem, it's a frequency problem. Even people manually buying small fractional amounts every single payday instead of consolidating into one clean monthly buy are quietly opting into more toll booths than they need. More trades doesn't mean more discipline. Past a certain point, it just means more friction. The spread itself isn't the actual scandal, frequency is. Micro investing turns you into someone paying a transaction cost hundreds of times a year for the privilege of feeling responsible daily. And the spread isn't even the main event, it's the appetizer. The actual bill shows up somewhere most people never check. The monthly subscription fee sitting quietly on the statement doing nothing but existing. Let's put a real number on that one. Say your app charges a flat $3 a month. Sounds tiny, basically a coffee, except you're already spending real money to feel like you're saving money on coffee. So let's actually do the math instead of just vibing past it. $3 $30 a month is $36 a year. If your balance is $50, completely normal for someone just starting with Roundup apps, that $36 fee against a $50 balance works out to be 72% annual expense ratio. For context, an actively managed mutual fund charging 2% a year gets dragged by every finance channel on this platform, including me. 72% isn't predatory. It's not even in the same category. It's a fee structure that mathematically cannot be beaten by any return on the stock market in human history. Compare that to where the money should be going. Plenty of 2026 index funds and ETFs tracking the total market carry expense ratios so low they basically ground to zero. A fraction of a percent per year, not per month, per year. Every dollar goes towards buying actual shares of actual companies, not maintaining a mascot, a push notification system, and a UI designer's salary. And here's the part that makes it sneaky instead of just bad. That ratio doesn't stay at the 72% forever. Grow the balance to like $200 and the same $3 fee suddenly only looks like 18% a year. Grow it to a couple thousand, and it drops something that barely registered. That fee didn't get smaller, it just got better at hiding, right as you started trusting the app more. That fee, it's not scary on its own. $36 a year sounds survivable. What's scary is the ratio that it does to a small balance specifically. It guarantees the account can basically never grow because the fee eats the seed before it sprouts. And can't grow isn't a 1-year problem, it's a 30-year problem. Because the cost of a bad fee structure isn't what it takes from you today, it's every future dollar that money was supposed to become and never will. Let's zoom all the way out. 30 years. Take someone rounding up purchases their whole adult life. Realistically, once you average the good weeks and the broke weeks, that's maybe $75 a month. Now take someone else, same income, same lifestyle, who instead sets up one boring automated transfer, $500 a month into a total market index fund. No app opens, no progress bar, no dopamine, just a transfer that fires whenever they're paying attention or not. Run both forward 30 years at a historical average market return, say 10% a year, nothing exotic, and here's roughly where they land. Roundup person, somewhere around $170,000. Disciplined person, somewhere north of $1 million. That's not a difference. That's a different financial life. Same market, same 30 years, same starting point. The only thing that changed is which habit got automated and which one stayed a feeling. And it gets worse before it gets better because a lot of these apps don't just tax on how much you invest. They gamify what you buy. Trending stock lists, like what's everyone buying today? Leaderboards, little badges for picking a name you recognize. It feels like strategy, it's not strategy. It's entertainment wearing a ticker symbol. And notice what actually makes those trending lists in the first place. A stock trend because it already moved, because it's already had its exciting run. You're not discovering early, you're discovering it at the exact moment it's been on everyone's screen for weeks, which is closer to the end of the story than the beginning if it's a bad company. Study after study on retail trading behavior shows the same pattern. People chasing exciting, trending, individual picks tend to underperform a total boring market index over time, largely because excitement and good decision making pull in opposite directions. The stock everyone's talking about, by definition, already priced for everyone talking about it. The unexciting, diversified fund quietly capturing the whole market's growth doesn't need you to feel anything about it. It just needs you to leave it alone. So the real cost of gamified investing isn't the only fee and it isn't the only spread. It's that the entire experience is engineered to keep your attention on the app when the actual goal of investing is to need the app as little as humanly possible. So knowing all of that, what do you actually do with the Roundup app sitting on your phone right now? Let's fix it. Here's the 3-step version I promise you. Step 1, audit the fee, not the balance. Pull up your statement, find the monthly charge, divide it by whatever's actually sitting in the account. If that number is anywhere near double digits as a percentage, that account's job now is transition vehicle, not investment. Step 2, migrate the automation, not just the money. The reason the Roundup investing felt appealing was that it happened without you thinking about it. Keep that part. Open a low-cost brokerage or index fund account, the kind with a genuinely flat or near zero fee structure, and set up one automatic transfer on payday. Not 50 cents at checkout, a real percentage of your income moved before you ever see it sitting in your spending account. Doesn't have to be $500 on day one. Start at whatever percentage doesn't wreck your budget. 5%, 10%, and raise it every time your income goes up. The number matters less, the fact that it actually happens automatically on a schedule without your feelings being involved. Step 3, and this is the one people skip, engineer the friction asymmetrically. Depositing should be the easiest thing you do all month. One tap, automated, no decision required. Withdrawing should require actual effort. Few extra steps, a short delay, maybe a separate app that you have to log into on purpose. You're not trying to trap yourself. You're just refusing to make impulse decisions as easy on the way out as the industry made them on the way in. That's the whole blueprint. It's not exciting. It's not like that deep. It's never going to trend, but here's the version that actually works. And it's the version none of these apps are financially motivated to tell you about. A customer who checks their portfolio once a quarter isn't generating their ad impressions. They're not generating engagement data or fee revenue. A customer who checks it every day is. And that's really the whole story here. The Roundup app isn't lying about the number on your screen. It's just very good at making a small number feel like a big feeling. Real wealth doesn't look like a notification. It doesn't look like a buzz in your pocket. It doesn't feel a progress ring. It looks like a boring account you haven't opened up in 4 months, quietly holding more shares than it did the last time you checked, compounding on your schedule without needing your attention, your excitement, or your permission. Thanks everyone for watching the video. Appreciate it. Hope you got some value out of this. I'll see you in the next one.